Assalamu alaikum. Welcome to lecture 69. So today we are going to cover tech companies. As I mentioned earlier, the tech companies is very different from your other normal trading companies. The way we analyze these companies is different, and there are some advantages and some disadvantages to it. So let's start with the tech companies. Now, the differences in the tech companies, okay, is in their statement of financial position. Okay. So, according to the conceptual framework, okay, statement of financial position, they measure the company's financial position, and statement of profit and loss measures their financial performance. We all know this, right? But when it comes to tech companies, okay, there is a growing concern that financial statements that are produced under IFRS standards, they do not provide useful information for tech companies when it is regarding the tech companies. Why is it? For example, tech companies like the big companies, the large giant companies like Amazon, Google, Facebook, Apple, you cannot analyze the company or measure the value of the company based on just their financial statements that are produced under IFRS standard. For example, statement of financial position and statement of profit and loss. Okay, this is the main difference when it comes to tech companies. Why? Because there are some drawbacks to it. So now let us go in depth in the statement of financial position. Why is the answer. Why we cannot measure the value of the tech company based on the statement of financial position or analyze the company. So number one reason is because tech companies' financial statements, they underreport a significant amount of value. Most of you know the tech companies, whether it's Facebook, Google, and all. What is their where does their significant value amount of value lies in? Is it the buildings that they have? Is it the non-current assets that they have? Is it the stocks that they have? Their human resource? What is it? It's their intangible assets. It's their intangible assets. They heavily invest on intangible assets. If you see the ratio, 85 to 90% is the value lies in the intangible assets for the tech companies, whereas only the remaining one is for the other assets. Therefore, financial statements, when they report, it underreports. It does not report the value, which what is the actual value of the tech company, because the tech company value is based on the intangible asset. So that financial statements fail to report. They don't report it. They underreport it. There are reasons why. Why do they do that? Number one reason. Number one reason. Okay. Okay. But before going to this, you have to know that the carrying amount of the net assets that goes in the financial statement of financial position for a tech company is very low compared to its market capitalization. Okay. Let me cancel this point. Why is it? Because what is market capitalization? Simply it is share price multiplied by number of share issued, right? So if you see the net asset, it is very much low compared to the market capitalization for tech companies. That is share price into shares in value. This is the reason why they underreport. That means they do not write the significant amount of value. They do not show it in the statement of financial position. Second, tech companies, okay, another reason how they can underreport a significant amount of value is because they have very powerful and very valuable brand. So which standard are we using? IFRS standard to measure intangible assets, IS 38. IS 38. So according to IS 38, there's a rule that it says internally generated brand you cannot recognize on the statement of financial position. Internally generated brand means the brand that you have created. For example, you have been in the Google for 10 years, 20 years, and in that 10, 20 years, you have created a brand known as Google. That is internally generated. You have not purchased it from somewhere else. So for internally generated any intangible asset, let's say brand, you cannot recognize it in the statement of financial position. Who says this? IS 38 says it. So according to IS 38, you cannot recognize in the statement of financial position. So you see, statement of financial position does not report it. They underreport the actual value. What actual value is more higher than that because tech company is based on their internally generated brand only. Their value is that. You understanding? So try to think of those tech companies in your mind when I'm explaining this concept here. This is a new concept. Okay, students often struggle for this. These are small little places where students often struggle to get marks. But trust me, these are very easy. Once you have understood this concept, you can secure very high amount of marks. Okay, unlike IFRS and all, because question number 1 and 2 is based on your ethics, your IFRS. You specifically have to know. You know it or you don't know it. But this type of questions, question number 3 and 4, tech companies, your additional performance measure, open-ended questions, you can skip through it because there's no definite answer. You can write it in any way you want. You don't have to refer to a specific standard, but you have to know it. It's very easy. Okay, because the portion of the syllabus is also very small. It's not very big compared to your uh, IFRS or IA standards and all. Okay, so it is not recognized. Now there is another reason. You have to know all these reasons. Okay, the reasons are very 2 or 3, but you can write a lot on it. Okay, the second is operating assets. Okay, operating assets that are used by tech companies are not usually owned by this tech company. They don't own or they don't lease it. Okay, they are not owned or leased by the company itself. The company itself, for example, Google, they might be using so many assets that they don't use it, they don't own or they don't lease it on their own. Example is given to you. I have written this, okay, as it is. Okay, as it is from your textbook. Usually I try to make it short and sweet, and I speak more and I don't write too much. I believe in that. But this one I've written as it is because it's very important, because most of you might be writing down notes. Okay, so in order for you not to, after this video, the purpose is you should not go back to your textbook and again study the same thing. It's the same thing. Okay, this is just the medium of delivery is different. That's a book. You have to read it. You have to do an active. This is a passive. Already video is out. You just have to go hear it. That's it. Maybe with explanations and all. So that's the reason I've included it as it is, because it's new also. And if you want to write examples, if you're struggling on how to write it, if I explain you, you might not understand certain things. You might miss out. That's the reason I've included the whole sentence as it is, not edited, not copy paste anything. I didn't cut it. As it is, I've put it here from your textbook. Okay. The second point. So operating assets. Okay. Not owned or leased by the company itself. Example I've given to you. You can write it down. Make sure you write it down. Okay, such as music available on Spotify. I'm sure all of you know what is Spotify, right? What is Spotify all about? If you don't know, you can just Google it. It's an app where all the musics are available. Okay, or the cars that are available to ride through Uber app. I'm sure almost everyone on the earth knows what is Uber app, right? So the tech companies, like whatever it could be, anything Facebook, Google, Amazon, they benefit from this asset. What is this asset? The music, the app. They benefit from this app, but they do not meet the criteria for recognition the statement of financial position, even though you're using this asset, because they are the tech companies, they do not own this asset or they do not lease this asset on its own. They're using some other company for that. That's why they cannot recognize this asset in their financial statement. Why? Because they are controlled by other parties. For example, uh, record labels, music that is available on Spotify. It is controlled by record labels and all. And Uber by taxi driver. Taxi driver controls Uber. So you cannot recognize that Uber app, whatever in your statement of financial position as an asset. You cannot do it. It's not controlled. Why? According to the definition of IFRS. If you're not controlling, you cannot recognize it as an asset. Conceptual framework says it. Please recall your memory of conceptual framework, the definition of an asset, liability, all those things while answering this type of questions. It's very important. Then you will be able to understand this better. Because when you're not controlling something, you cannot recognize it as an asset. Simple. That's the same reason. So even though tech companies are the one who are actually using the benefit of it, getting the benefit out of this, they are not owning it, so they cannot recognize it also. Because of this, again, their value is going down in the statement of according to the statement of financial position. Why are we talking about statement of financial position and statement of profit and loss? Because we analyze tech companies based on this too. Okay. And then third reason. What is the third reason? Intangible assets. Many intangible assets are developed and used by tech companies. Okay, many intangible assets that are used and that are developed by the tech companies, what happens normally appreciate in value. In the real life, if you see, research any company, take out any company, Amazon, Facebook, Google, and see, they appreciate in value or they depreciate in value. They appreciate in value. Value is going higher and higher and higher each day. But if you're using accounting standards, okay, IS 38, if you're using IS 38 or IS 16, what does it say? It needs to be depreciated or amortized. Accounting standards say. Normally, whenever you're having a non-current asset or an intangible asset, what do they say? If you're having an intangible asset, they say it has to be amortized. But is it happening so? No, it's appreciating in value in reality. But according to accounting standard, to comply with the accounting standard, you are showing that they are amortizing. So again, you are underreporting the significant amount of value that is in intangible asset. You understanding? So because of these limitations, the different nature of tech company, you cannot analyze the tech company based on its statement of financial position alone. Understand? Because it underreports their significant amount of value. Okay. One example for the last point. Okay, one example I would like to give to better understand how it appreciates in value. Okay. All of you know social media, right? Every one of us are there on the social media platform. We know about it, right? So for example, if there is any new user on a social media platform, for example, you are a new user, you are making a account on Facebook or Insta. Okay, what happens? It increases the benefit for the existing user, the platform for the existing user. Any new user comes to the social media platform, it increases the benefit for those who are existing on that social media platform. The benefit, how? As well as, okay, as well as increasing the advertising fee also for the platform owner, whoever is owning that Facebook, whoever is owning that WhatsApp, whoever is owning that Instagram. It increases their advertising fees, okay, that they can charge. Why? Because every user who is there, they are getting an amount. The platform owner is getting an amount from that. How many of the users there on that social media platform? So it's increasing for them, right? So if you see, the benefit is more than the cost. Cost is not increasing so much. Cost is not increasing in line with the benefit. Benefit is increasing. Already their social media platform is there. What do you have to do? You just have to add multiple time. Okay, I don't know how many. There is no limit to the user that can be there on a social media platform. That could be there on a Facebook. It just keeps on increasing. Okay, even though there is some small incremental operating cost might be there with the new user. Okay, what are those incremental cost? For example, you might need to give them support or some kind of help, okay, or some regulation of online behavior. Okay, so for that, some cost will be there for the platform, the user, sorry, the owner of the social media platform. But other than that, benefits are huge. Every new user is there, benefit is increasing for the owner of the platform. Why? Because the growth is mainly driven by the assets already in place. Because of that asset, because of the social media platform, that's an intangible asset. Because of that, when growth is increasing, it's not just because you're incurring some kind of cost or anything. Cost, yes, only small amount of cost for the new users, small amount, but benefit is huge. So that's what's appreciating in value. Once it's developed, yes, initially there will be costs are very high, but later, once it starts turning into revenue and getting profit, it keeps on getting profit only. There is no cost, is very minimal. So based on that understanding, now we are moving towards statement of profit or loss from this perspective, that cost is very high and this one is very low. Because of that, okay, so we know that many tech companies such as Uber and Twitter, they are valued at billions of dollars, billions. You have no idea how much. Even though they have historically made it losses, and these losses are not small amount of losses, huge amount of losses they have made. Now they are making in billions. To know the exact figure, you have to research, you have to Google and see what is the exact figure. If you want to check in terms of their profit and loss, if you want to check their profit and loss statement, Google and check. Okay, I'm not sure, I have not done it, but maybe you can go and check it out to know the exact figure. But billions of dollars they are earning. Okay, so Because of this, when you're assessing their performance based on just statement of profit and loss, it becomes very hard. Because initial years they'll be making losses. So based on that, if you predict their future, you might be thinking, oh, this is making losses currently, means in the future also they'll be making losses, which is not true. Just see the tech companies, see their history, and see the what currently they are doing, their position. Because investors, they see beyond the statement of profit and loss, especially for the tech companies. Because tech company, the nature is such that initial years will be making losses. Why? Because their value is heavily on intangible assets, not any other assets. If it was some other assets, yes. If it was based on their humans resource, they can value high qualified staff. If it was on non-current assets, they can get the non-current assets. But here it's not like that. For tech companies, is their intangible assets, their knowledge. So it takes time to get that knowledge, to train them, to have a brand, to build up that brand. It takes some years. Sometimes it could be 5 years, beyond 5 years, I would say 7 to 10 years it might take. Some companies even take more than that, but it takes a good amount of time. Okay, so that's the reason when investors, they want to assess the performance of the tech companies, they just cannot rely on statement of profit and loss alone, because it will show two different picture. If you see 10 years before, what is the performance of the Uber compared to now, performance is totally the opposite. It's very hard. That's why investors, they see beyond, they need in beyond statement of profit and loss. You have to be able to predict. Process the tech companies. This is for tech companies. Okay, I'm referring to, not any other company. Normal company, you just look at the statement of profit and loss, statement of financial position, and you see. Next, tech companies, they incur higher cost in the initial. This is the property of it. Higher cost in initial years after incorporation. But once these costs are incurred, then later on, whatever the cost is, the further cost that are required to expand. For example, the example that I've given you on the social media platform, initial cost was to set up the platform. It took a huge amount of cost. Once it is set up, now any new user comes there, the cost is very minimal compared to that initial cost. So you are expanding only through that new user. So further costs that are required to expand are lower in comparison. Okay, example I've given you, companies that offer online services, they can expand how? Just by adding the server capacity. That's it. Add one server capacity. That's it. You don't have to acquire the whole new premises for each time a new user is there. No. Only the server capacity, just expand. That's it. Okay. So because of this, successful tech companies, they often report losses in the initial years for many years. That too for many years, not just 1 or 2 years. But then once they're established in the market, just look at their margins, billions of dollars that market is. Very high margin established, and they're established as what? As a market leader. They are the ones who dominate the prices because they become a market leader in that field. Because of that, okay, at all stages in the life cycle of a tech company, statement of profit, okay, or loss, they do not help you to match the revenue with the cost. Okay, they do not help the revenue that is earned in the current period with the cost that is incurred to earn those revenue. You cannot use the statement of profit and loss for that, because initial years only loss. Later it's revenue. But the cost that you have incurred to get that revenue was done initially, the earlier years, but that time you didn't recognize the revenue, because according to the IFRS standard, what does it say? Conceptual framework, you have to recognize the cost in the year, in that period when you have incurred the revenue. Cost matching, right? You have to matching concept, revenue and cost. But here is different here. So statement of profit and loss again is not a good tool to analyze the tech company for this reason. Then investors, okay, it does not mean, okay, another thing guys, it does not mean the statement of profit or loss is worthless, or you should not look at it at all to analyze the performance. No, it does not mean. But investors are certainly interested in the revenue that is generated by tech company. They want to see also the share price. Why? Because they increase very significantly in the first period when a profit is recorded. The first time when a tech company incurs a profit, share price increases very significantly for the tech company. If you see the tech company, how it operates, most of them is overvalued. That's why it's very hard to acquire a tech company. For the acquisition and merger purpose, acquiring a tech company is very high, very risky, and also the price that you have to pay is very high because they are very overvalued. If you go by the share price, it's overvalued that market. Overvalued means that market has a high capacity to grow. The capability of the potential of that market, the growth is very high. That's the reason it is overvalued. Okay. If you know finance very well, you should be able to understand this in the finance. Okay, in the advanced financial management, I've thought that why tech companies are overvalued. This is the reason. Okay, if you see where the share price is often overvalued, that's why it becomes very hard for rivals to acquire a high tech company. Companies like Google and all those things. Okay, and what else am I missing? Because why is it? Because it's a good indicator. Why share prices increases significantly when profit is recorded? It's a good indicator of growth or growth and market share. It could be a good indicator of a growth and a market share. That's the reason. Okay. So profit generation. When does a tech company generates profit? This also you have to understand. Profit generates means they have moved into a different life cycle. We all know that every product has a life cycle. Okay. Initially it is taking a birth, it grows, then it develops, then it reaches to the mature stage, cash cow, and then it falls, declines, right? That life cycle same for tech company also. When you start making a profit, for profit generation means life cycle, they're in the different life cycle. The tech company, they have reached to that mature stage, cash cow, they are now cash cow. Okay, that means they're not that risky, they are less risky now. Okay, they are now generating cash, but in the initial stage when they are growing, that is the stage when the risk is also very high. Okay, and capital, and they demand capital also. A huge amount of capital is demanded in the initial stage. So when you're generating profit means they have moved into the different life cycle. This is a way you analyze it. Tech companies. Okay, now finally the end. Okay, so end is the remedies. What do you do? How do you solve this issue? Because statement financial position has one issue. They do not recognize the amount, the value under reports, and statement of profit and loss also has some issues. We went through it. Now how do you solve it? Every problem needs to have some remedy. So because of those weaknesses, okay, tech companies have to report other types of information to investors and lenders. How can they do this? Number one, integrated reporting. Tech companies, they need to present integrated reporting. Integrated reporting now is done by other companies also, but for tech companies, the importance is more, the significance is more now because of the limitations of statement of profit and loss and statement of financial position. And integrated reporting, I will be covering it later in the later videos. Okay, that's, I think it's the last video under analysis and interpretation, this topic, right? That's the last, so that I'm going to cover. And then online real-time reporting of key performance indicator. Online real time, that also, as soon as it's happening, you report the key performance indicator. What are the key performance indicators? Such as membership number. You can see the membership number. Monetary spent per use, that means, for example, if you are checking the Google or Facebook or whatever it is, Uber, how much is spent on Uber per day or per user? You can check this out. This is specifically for the tech companies, not other companies, because other companies you can analyze through normal statement of financial position or financial statements, not for tech companies. Okay, so because of this reason, you need to study further things like integrated reporting and all. So that's it, guys, for tech companies. And next will be a very easy non-financial performance measure. So all this while we have been covering financial measure, additional performance measure, then we covered tech companies today. How do you measure tech? Now we are moving towards non-financial performance measure, because remember, when you are analyzing a company, it's not just a financial performance measure. You also have to analyze a company through non-financial performance measure as well. Okay, so this is a very easy topic, very easy topic. Okay, So till then, thanks for watching and see you in the next video.